value calculation equal to 0. The fourth evaluation technique that we want to use is the payback period. So the payback period is the project's break even in years. Basically, when do we recover the initial outlay? That's what the payback period is. So this technique has two different calculations, and these two different calculations are based off the patterns of the project cash flow. Now, this method is the least sophisticated, but this is the one that most appeals to your managerial intuition. Now, with the payback period, the lower the better. You want your project to pay for itself sooner rather than later. With the net present value, profitability index, and internal rate of return, you wanted those figures to be as high as possible. With the payback period, you want that to be as low as possible. Let's discuss the intuition of the payback period. We perform the calculation, and the payback period for the project is 20 years. 20 years, that's a long time. You'd probably reject the project even if the net present value, profitability index, and internal rate of return all say to accept the project. With a payback period of 20 years, that just doesn't feel right. That just doesn't appeal to your intuition. 20 years in general is too long for a project to pay for itself. You'd want the project to pay for itself within a much shorter time frame than 20 years. Now, the payback period, when you do the calculation, should be the number of years. The payback period must be less than the life of the project. So if you have a project that has a 5-year life, and you calculate a payback period of 8 years, that doesn't make sense. The project doesn't last long enough to pay for itself in that example. The payback period occurs when the sum of the after-tax cash flows is greater than or equal to the initial outlay. So you keep a running balance of your after-tax cash flows. In what year is that running balance greater than the initial outlay? By definition, that's the payback period. And again, you want your payback period to be as low as possible. So let's consolidate these techniques. You've done all these techniques. The net present value is greater than 0. The profitability index is greater than 1. The internal rate of return is greater than the net present value interest rate. The payback period is low. In this situation, the project should be accepted. When would you reject the project? When the net present value is less than 0? When the profitability index is less than 1? When the internal rate of return is less than the net present value interest rate and the payback period is high. In this situation, you're going to reject the project because all of these metrics indicate that the project is not profitable. Well, unfortunately, in real life, it's not this straightforward. All your results don't give you a consistent decision. Many times the techniques will frequently give you conflicting results. The point is that complex, expensive projects will require managerial judgment, discipline, and intuition. And the effective manager anticipates this problem. The effective manager anticipates that there's going to be a conflict within the techniques. and the effective manager has a process to deal with these inconsistencies. All right, now let's try an example. A project will cost $750 and has a life of 3 years. It will generate savings of $100 in year 1, $200 in year 2, $300 in year 3. Revenues will increase by $100 in year 2 and $200 in year 3. The salvage value is estimated to be $100. Calculate the net present value, profitability index, internal rate of return, and payback period for this project. And when you perform your net present value calculations, use an interest rate of 10%. So the first thing to do in this project, in these calculations, is to calculate the after-tax cash flows. So remember that your after-tax cash flows is the sum of your cost savings and your increases in revenues. So in year 1, your cost savings are 100, the increases in revenues are 0, your after-tax cash flow is equal to 100. In year 2, the cost savings are 200, the increases in revenues are 100, the after-tax cash flows are $300, and in year 3, the cost savings are 300, the increase in revenues are 200, the after-tax cash flows are equal to $500. The cash flow in year 3 is going to be a combination of the after-tax cash flows and the terminal value. So in the previous slide, we calculated the after-tax cash flow in year 3 to be $500. The year 3 terminal value is $100. Therefore, the cash flow in year 6 is $600. Again, it's the sum of the $500 of after-tax cash flows plus the $100 of terminal value. So this is what the project timeline looks like. In year 1, today we have initial outlay equal to $750. In year 1, we have after-tax cash flows equal to $100. In year 2, we have after-tax cash flows equal to $200, and in year 3, we have after-tax cash flows equal to $500. In year 3, we also have terminal value equal to $100. So again, you can see that your total cash flows in year 3 is $600. Now, based on these cash flows and based off the timing of these cash flows, is this project profitable? Is this project economically feasible? So using the algebra then, this is what the net present value calculation is, and this is what the profitability index is. The net present value is equal to the present value of your cash flow in year 1, plus the present value of your cash flow, your after-tax cash flow in year 2, plus the present value of your after-tax cash flows in year 3, the present value of the terminal value in year 3, you subtract out the initial outlay. When you do this calculation, you come up with a net present value equal to $39.63. Because the net present value is greater than 0, you will accept this project. You perform the net present value calculation, and the net present value then becomes an input into your profitability index calculation. So your profitability index is equal to the net present value of 39.63 plus the absolute value of the negative 750. That's in the numerator, and you're going to divide that by the absolute value of the initial outlay. When you perform this calculation, you're going to come up then with a profitability index equal to 1.05. Because the 1.05 is less than 1, greater than 1, you're going to accept the project.
Even though I know that the interest rate is 10%, could you go over the denominator in the NPV value for the other student? So just in case some student may not thinking,
We'll go out here then and we'll try it on the Excel.
Okay.
Yeah, and see how that works. Okay, so this is going out there and solving this problem using algebra. Now let's try this as an Excel application. So I want to set this up here, and I'm going to have the year, the cash flow, the PV factor, the present value of the cash flows, and the cumulative after-tax cash flows. So in this particular case, we'll have year 0, 1, 2, 3. This is the project life. And what are the cash flows? So in year 0, the only cash flow that we have is the initial outlay. In year 1, we have the cost savings. In year 2, we have the cost savings plus the increase in revenues. The cost savings plus the increase in revenues. In year 3, we have the cost savings plus the increase in revenues, plus the terminal value. So in year 3, we're going to have the cost savings, plus the increase in revenues, plus the terminal value. So we can do our first calculation now, and this will be the internal rate of return. Excel has the internal rate of return function already built into it. So the Excel function is equals IRR, left parentheses, highlight this vector of cash flows, right parentheses. So equals IRR, left parentheses, capture that vector of cash flows, right parentheses. It equals, let me format this a little bit. So the rate of return from this project is equal to 12.34%. Remember that we had to use we're going to use a 10% interest rate in our net present value calculation. So the internal rate of return indicates that we should accept this project. We borrow at 10%, but the project returns 12.34%. The internal rate of return indicates that this project is going to be profitable. Now, the question that was asked earlier then is about the present value factor. So let me go over that slowly. So in year 0, this is going to be equal to 1 divided by, left parentheses, 1 plus 10%. Again, that's the interest rate that was specified for the net present value. And all of this raised to, for year 0, the 0 power. In year 1, it's going to be 1, 2, 3. So this is the formula. 1 divided by, left parentheses, 1 plus 10%, and in year 0, that's going to be raised to the 0 power. I can copy that down so that in year 1, it's going to be raised to the first power, second power, third power. Let me format this. So these are the present value factors. Now, column D is the present value of the cash flows. Column D is equal to column B multiplied by column C. So in year 0, this is going to be equal to negative 750 multiplied by the present value factor. In year 1, that's going to be equal to 100 multiplied by the 0.9091. Let me format these to 2 decimal points. So these are the present value of each one of these cash flows. Again, you need to multiply column B times column C. You need to multiply column B times column C. So now, when we sum the present value of these cash flows, this is the net present value. So I'm going to sum these up equal to the sum of the present value of the cash flows and that's going to be equal to 39.63, and this is identical to the number that we saw when we did the algebraic method to calculate the net present value. So this is to show you that the algebraic method and the spreadsheet method that you'll commonly use are the same. The next thing that we want to calculate is the profitability index. So the profitability index is equal to the net present value plus the initial outlay divided by the initial outlay. So this is going to be equal to, let me cell reference to the net present value. Let me put a parenthesis here. Let me cell reference to the net present value plus the absolute value. ABS is the absolute value function within Excel. So that's the numerator. All of that divided by the absolute value of the initial outlay. So there's the profitability index in spreadsheet form. When we do that calculation, there's the 1.05 that we saw a little bit earlier. The next thing that we want to calculate is the cumulative after-tax cash flows. So that in year one, my cumulative after-tax cash flows are equal to 100. In year two, my cumulative after-tax cash flows are equal to 100 plus the 300. In year three, my cumulative after-tax cash flows are equal to 100 plus 300 plus 500. Not the 600 that's shown there, because the 600 includes terminal value. We need to deduct the terminal value from the year three cumulative after-tax cash flows. The terminal value was equal to 100, so we need to deduct the terminal value because column E, the cumulative after-tax cash flow calculation, only focuses on after-tax cash flows. Terminal value doesn't belong there. So in year three, the cumulative after-tax cash flow is $900. In what year is the cumulative after-tax cash flow greater than the initial outlay, the absolute value of the initial outlay? This occurs in year three. So the payback period for this project is 3 years. So that's the spreadsheet method of calculating your net present value, your profitability index, the internal rate of return, and the payback period. And nowadays, with spreadsheet applications, it's more common to perform your capital budgeting and engineering economics using spreadsheet applications. I'm going to jump back now to the PowerPoint presentation.